Breaking news tonight from the gold market, where a stunning reversal has upended what only days ago looked like an unstoppable rally. After surging to historic highs earlier this week, gold prices have now fallen sharply in a dramatic turn that has rattled investors and reset expectations across the precious metals space. Good evening. We begin with a sharp turn in the gold market after a historic rally earlier this week. Gold prices fell dramatically in the latest trading session, retreating from record highs as the US dollar strengthened and market volatility intensified. The move marked a decisive shift in momentum, ending a rapid advance that had carried gold to unprecedented levels only days earlier. The decline was swift and wide-ranging, unfolding during a single high-volatility session and sending ripples across the broader precious metals complex. For investors, traders, and physical buyers alike, the reversal has reset short-term expectations and refocused attention on currency movements and monetary policy signals. Because U.S. markets were closed on Saturday, January 31, 2026, most market participants are treating Friday's closing prices from January 30th as the effective reference point for today's gold price. Trading activity late on Friday continued electronically after the official settlement, with prices remaining volatile into the evening hours, all times Eastern. Those late-session moves underscored how abruptly sentiment shifted and how quickly positions were adjusted as new macroeconomic signals entered the market. At its core, the story is not simply that gold prices declined, it is how they declined. The pullback was not gradual or orderly. Instead, it came as a rapid reversal marked by unusually large intraday swings. Prices fell hundreds of dollars per ounce within hours, reversing a multi-day surge and forcing a reassessment of what had been driving demand. The sharpness of the move matters because it reflects changing conditions across currency markets, interest rate expectations, and risk management behavior among investors. By the close of trading on Friday, gold remained far above levels seen a year earlier, but it was significantly below the peak reached earlier in the week. Both spot prices and futures contracts recorded steep losses. Late session data showed a wide trading range, a sign that liquidity conditions had thinned and that market participants were moving quickly to reduce exposure. These dynamics are often associated with periods of heightened uncertainty, when rapid price changes trigger defensive adjustments across portfolios. Looking at specific price references helps illustrate the scale of the move. Spot gold, commonly tracked under the symbol XAU against the US dollar, was quoted late Friday at approximately $4,890 per ounce. That represented a sharp drop from the prior close near $5,373 per ounce. During the same session, spot prices fluctuated between roughly $4,680 at the low end and about $5,450 at the high end. Those figures reflect an unusually broad range within a single trading day. Gold futures showed similar volatility. The most active COMEX gold futures contract settled at around $4,765 per ounce at the official Friday close. That was down significantly from the previous close, near $5,411 per ounce. Intraday trading in that contract ranged from approximately $4,703 to about $5,480 per ounce. After the primary settlement window, futures trading continued electronically, with a late-session last price quoted near $4,908 per ounce at 9:39 p.m. Eastern Time. It is important to note that differences between the official futures close and late electronic prices are normal. Futures contracts continue trading beyond the main settlement period, while spot prices update continuously. During volatile sessions like this one, those differences can widen as trading conditions change rapidly. The abrupt downturn followed a shift in the broader macroeconomic narrative that had supported gold's climb. Earlier in the week, gold had benefited from a combination of factors that favored safe haven assets. By Friday, however, attention had turned toward the US dollar and evolving expectations around the future path of US interest rates. News connected to the outlook for Federal Reserve leadership contributed to that change in focus, prompting a broader reassessment of risk across financial markets, including precious metals. As the dollar strengthened, pressure mounted on gold prices. Because gold is priced in US dollars, a rising dollar can make the metal more expensive for buyers using other currencies, which can weigh on demand at the margin. At the same time, shifting expectations about interest rates can influence the appeal of holding assets like gold that do not offer yield. When those expectations change quickly, especially in markets where leveraged positions are common, price reactions can be amplified. The scale of Friday's intraday movement also suggested that more than discretionary selling was at work. In several price references, the distance between the week's highs and Friday's lows ran into the thousands of dollars per ounce. Such moves are often associated with forced de-risking, where rising volatility leads to tighter margin requirements and stricter risk limits. Under those conditions, selling can accelerate as traders move to meet obligations or reduce exposure, turning what might have been a controlled pullback into a cascading decline. The impact was not confined to gold alone. Other precious metals, including silver, experienced even steeper losses during the same period. The simultaneous declines reinforced the view that the sell-off was driven by common macro factors rather than by changes specific to any one metal. When closely linked markets move sharply in tandem, it often points to influences such as currency strength, interest rate repricing, and broad portfolio adjustments. Gold plays a central role in the precious metals space, often shaping sentiment across related markets. When gold prices break sharply, it can trigger mechanical selling in funds and strategies that treat precious metals as a single risk category. Those flows can magnify moves in thinner markets, which in turn can feed back into gold through hedging activity and coordinated exposure reductions. As this market adjustment unfolded, questions emerged about what the sudden reversal means for different participants. Physical buyers, futures traders, and long-term holders all experience volatility differently. The sharp drop in spot prices does not always translate directly to retail pricing, especially during periods of rapid movement and reduced liquidity. For investors with longer horizons, attention tends to remain on broader drivers such as currency trends and real yields, rather than on single-session price swings. This brings us to a critical point in the story. While the headline move was a steep decline, the broader context includes ongoing uncertainty and elevated volatility. The market has shifted from a smooth upward trajectory to a more complex environment where prices can move quickly in both directions. Understanding how that transition affects pricing, liquidity, and risk management will be essential in the days ahead. As markets absorbed the scale of Friday's reversal, attention turned to what the sudden shift revealed about underlying conditions in the gold market and across precious metals more broadly. The speed and magnitude of the decline underscored how quickly sentiment can change when multiple macroeconomic factors realign at once. While gold remained well above levels seen earlier in the year, the latest session forced a rapid reassessment of positioning, particularly among participants who had benefited from the recent surge to record highs. One of the defining features of the session was the exceptionally wide trading range. Both spot and futures prices moved sharply between their intraday highs and lows, signaling a market under stress. Such ranges are often interpreted as evidence that liquidity has thinned, meaning fewer willing buyers and sellers at each price level. When liquidity drops, price movements can become exaggerated, especially when large orders or automated strategies enter the market. This dynamic was clearly visible as prices fell rapidly from earlier peaks. The timing of the move also played a role. With the week drawing to a close and U.S. markets heading into a weekend pause, some participants moved quickly to reduce exposure rather than carry heightened risk into a period of limited price discovery. Late electronic trading showed that volatility did not subside after the official close. Instead, prices continued to fluctuate into the evening, reinforcing the sense that the market was still searching for balance. Central to the shift was renewed strength in the U.S. dollar. Currency markets often exert a powerful influence on commodities, particularly those priced in dollars. As the dollar rose, it altered the relative cost of gold for buyers outside the United States. Even small changes in exchange rates can have meaningful effects on demand when prices are already elevated. In this case, the dollar's advance coincided with a reassessment of how much safe haven demand was justified at current levels. At the same time, expectations surrounding U.S. interest rates moved back into focus. Gold does not generate income, so its appeal is often evaluated relative to the returns available on interest-bearing assets. When markets anticipate changes in the policy outlook, especially over a short time frame, that calculation can shift abruptly. The news tied to the outlook for Federal Reserve leadership acted as a catalyst, prompting a broader risk reset across precious metals. That reset involved repricing not only gold, but also silver and related assets. The interaction between currency strength and rate expectations created what many traders view as a double headwind for gold. A stronger dollar can weigh on demand, while rising or uncertain interest rate expectations can increase the opportunity cost of holding non-yielding assets. When both factors move simultaneously, the combined effect can be amplified. In leveraged markets, where positions are often built using borrowed capital, such amplification can lead to forced selling. Forced de-risking became a key theme as the session progressed. As volatility increased, margin requirements and internal risk limits at trading firms can tighten automatically. When that happens, positions that were sustainable under calmer conditions may need to be reduced quickly. This process can turn ordinary profit-taking into a cascade of selling, pushing prices lower than they might otherwise go in a more orderly market. The sheer size of Friday's intraday swings pointed strongly in this direction. The sell-off's reach beyond gold added weight to the interpretation that common macro drivers were at work. Silver and other precious metals recorded even sharper declines, moving in the same direction and at the same time. Such synchronized movement typically reflects broad portfolio adjustments rather than changes in fundamentals like industrial demand, jewelry consumption, or mining output. In this case, there was no indication of a sudden shift in physical supply or end-user demand driving prices lower. Gold's role as a benchmark within the precious metals complex also mattered. Many investment products and trading strategies group metals together, allocating capital based on overall exposure rather than individual market characteristics. When gold prices break sharply, those strategies can trigger mechanical selling across multiple metals. This can amplify declines in markets that are thinner or less liquid, which then feeds back into gold through cross-hedging and risk reduction decisions. As prices moved lower, the implications for physical buyers began to come into view. A large drop in spot prices does not always translate directly into what consumers or investors see at a dealer counter. During periods of heightened volatility, premiums can widen as dealers manage inventory risk. Some retailers may also adjust prices less frequently, particularly over weekends when wholesale markets are closed. As a result, the headline spot price may not fully reflect transaction prices in the physical market during such periods. For long-term holders, the immediate question was whether the sharp decline altered the broader forces that had driven gold higher in the first place. Those forces include currency trends, real interest rates, and demand for hedges during periods of geopolitical or policy uncertainty. A single volatile session, even one as dramatic as Friday's, does not automatically resolve those longer-term considerations. However, it does affect how and when investors choose to add or adjust positions. Two practical implications stood out as the market recalibrated. The first was the heightened importance of timing. In a market where prices can swing hundreds of dollars per ounce within hours, the concept of a single gold price becomes less meaningful. The value depends heavily on the exact moment a transaction occurs. This reality places greater emphasis on execution and monitoring, particularly for participants operating in fast-moving markets. The second implication was the renewed focus on risk management. Even investors who maintain a constructive or bullish view on gold often change their approach when daily price ranges expand. Scaling into positions, using hedges, or reducing leverage becomes more common when volatility rises. Friday's session reinforced that risk management is not a peripheral concern, but a central part of participating in the gold market during periods of rapid change. As the weekend pause set in, it limited immediate price discovery, but did not remove uncertainty. With trading activity temporarily reduced, attention shifted toward the indicators that would shape the next phase of movement once markets reopened. The transition from a steady rally to a two-way, headline-sensitive environment was already underway, and participants were preparing for what might come next. In the end, the gold market's sudden reversal served as a reminder of how quickly conditions can change when currency strength, interest rate expectations, and risk dynamics converge. As markets look ahead, the focus now turns to whether stability returns or volatility continues to define the landscape. Stay informed, stay engaged, and if you found this update valuable, like the video, share your thoughts in the comments, and subscribe for more timely market coverage.